Obviously, everyone's been, going to be hanging so closely to this work report and how big of an event this MPC is going to be for markets. But how important is it going to be as a catalyst for this equity rally to continue? Kendra, I'll start with you.
It's very important. Obviously, during the 2 sessions, we'll likely get more policy information, growth targets. Everyone's so focused on that. I guess we're not too different from consensus when it comes to the actual numbers. So we're looking for around 5% growth for 2024. And the other big number, of course, is fiscal deficit to GDP ratio. We're looking for above 3% on budget fiscal deficit. But I think the more important number that we are very focused on is the so-called augmented fiscal deficit, which means that we aggregate both on-budget and off-budget deficit spending together. And on that basis, we're looking for about 12% deficit spending to GDP, which represents an incremental expansion of fiscal policy relative to 2023. So from that basis, I think if we get that number, I think that will help, I would say, maybe solidified or just to improve confidence a little bit and to really stabilize growth expectation, especially when it comes to corporate earnings growth expectation.
Winnie?
Yeah, I mean, I think, apparently this is something people are watching. There are 3 issues with the market, as we discussed before. One is the continued property downturn, especially the depreciating asset prices creating a negative wealth effect on household. So for us, more specifically, anything to help stabilize the property market, the confidence on the property market. Second, the longer-term problem is, what is going to be the new growth driver? Is that AI? Is that new technology? And specifically, how is government policy going to promote innovation, promote China's development in those areas? But those 2 are really more longer-term effect. But for the short term, the specific third area is more about rebuilding the confidence, right? The confidence of the private sector, about the confidence of household. And along those lines, I think, we would like to see whether there's more focus on pro-growth policies, whether there's more accommodative policies, more on opening up reforms.
You're thinking when it comes to potential upside in this equity market, Winnie, it might just be sort of a L-shaped sort of. Can you walk us through why?
Yeah, that's still our base case view, because I would say fundamentally, for the economy to turn around, it's not so much about stimulus. I mean, stimulus is important, but I think China has passed the stage where they want to throw a lot of money, build a lot of leverage just to achieve a 7%, 6% GDP growth. Current government focus on high quality growth. So I think from economy perspective, government policy is more likely about holding the floor rather than driving a very strong policy, economic recovery. And then in terms of the credit policy, also similarly, we're not expecting a strong credit stimulus or policy bazooka. But also importantly is from global investors' perspective, are the real money long-term global fund going to come back to buy China just because China announced a 10 trillion stimulus? Probably not good enough, right? So some of these fundamental turnaround just takes time in our view.
Yeah, but you have somewhat of an opposite view, somewhat of a more constructive view of equity markets.
Well, we do share the L-shaped pattern, but this is more for the property market. So we've been very vocal about that. Yeah. We think the property market deleveraging will take a few years to play out. But when it comes to the equity market, slightly different views. Maybe it's more like a L-shaped, but
inverted?
Inverted, yeah.
Okay.
So I think when you look at our targets, we're looking for about 10% potential price returns over the next 12 months for Chinese equities, both A and H. And I think the inputs to that view would be, number one, we still think that this year earnings growth would be decent. We're looking for about 8 to 10% earnings growth. On top of that, valuations, I'm sure everyone knows that we're at pretty depressed level. So 9 times for MSCI China and about 10 times, 11 times for A shares. So that combination with potential some policy support coming out from the 2 sessions, we think that we have a pretty good setup for the market to do better in the next 10 to 12 months.
Okay.
Yeah, and I think one of the areas we just showed it where you guys somewhat diverge, and we celebrate your differences, of course, here, is the earnings outlook, right? So you have single digits.
Low single digits.
Low single digits. You almost have double digits, if not double digits. So where are you seeing the biggest earnings driver, and what's lacking still as far as the earnings push is concerned? What do you see?
Well, first of all, I think relative to consensus, we think consensus looks a little bit quite optimistic.
Okay,
compared
14
to where
to
we
17%.
are. 14, 15% for both A and H. I think it is quite
Well, it's always
quite
14%.
high. Yeah, exactly.
That's a magic number.
Yeah. But when it comes to where we get growth from a corporate earnings standpoint, I would say number one, we think that the TMT sector will be still a pretty important growth contributor to the market. We're looking for about mid-teens type of earnings growth for TMT sectors. On top of that, I think some consumer names and even like some SOEs, I think they'll be generating pretty decent earnings growth for this year. But of course, when you zoom into the housing cohort, I think equities related to the housing market will struggle to grow.
What's the rest of all that, Winnie?
Yeah, I think, if you look at the sequential trend, the question to ask ourselves is this year's earning growth going to be faster or slower than last year? And our answer is probably similar to slower, right? Because look at the major earning component. Financials consistently account for 40 to 50% of earnings within both the MSCI China universe and the Asia universe. And for major banks, earning growth this year is probably going to be slightly lower than last year. Internet, autos, renewables, these sectors, the growth sectors also last year benefited from the high base because of the reopening, low base effect in 2022. But 24 versus 23 is likely to decelerate. Overall GDP growth, we are also looking at a modest deceleration. So I would say this year, 24's earning growth is likely to be lower than 23, and consensus now looking at full year 23 MSCI China earning growth probably around 2%. So I would say 24, the reality we might get 2% or even slightly lower.
Okay.
Just laying that.
So that keeps you defensive, I would imagine, right?
Yes.
So you still like SOEs, high dividend plays.
You have this new report.
Yeah.
Yes.
Tell us
SOE
about the book.
Reform 2.0 and the Fantastic Four sectors. Tell us about it.
That's right. So SOE has been a sector that global investors ignored, right? Generally, when global investors buy China, they like to buy growth. So internet, healthcare, autos, consumer, those hot growth sectors, which traded at much higher premium than SOE. But in the past 2-3 years, what we find is actually private sectors suffered much more derating because of slowdown, because of increased policy risk and elevated geopolitical tensions, whereas SOE sector has been outperforming, whether it's past 3 years, 10 years, or year to date. So the Fantastic Four sector are financial, telcos, utility, and oil and gas sectors. Within that, coal sector year to date is up 20%, oil sector up 20%, even the banks is up 9% year to date when MSCI China is down. And we think the story might continue this year. One is because we stay defensive as we are not so bullish on the growth outlook. But also, SASAC, the state administrator for the SOEs, in end of January actually launched a new initiative similar to what Japan and Korea is doing. It's basically encouraging or urging SOEs to focus on unlocking their value, unlocking, driving the multiple re-rating. So, whether it's enhanced communication with investor or increased buyout, increased dividend payout, or even do more buybacks, we think there could be more of those initiatives to drive more return.
And not that it's a zero-sum game as far as, strategy is concerned, but what do you think would be the winning strategies? If not this, what would that be?
Well, first of all, I would concur with Winnie's
You're
view
really
about
polite, Kitcher.
Yeah. So I think cash returns when it comes to dividend payments and buybacks would be something that we like on a global basis, not only in China, but we also like that in the US, we like it in Europe as well. So we're not too different from that perspective. But as I said, I don't think it's a binary decision when it comes to how to invest or allocate capital in the Chinese equity market. So besides like high dividend yields and SOEs, I think there are also quite attractive opportunities in the POE sector. As I mentioned earlier, we think that TMT sector is still generating pretty decent growth and trading at very depressed valuations. And some really big companies are engaging more actively in buybacks. So if you want to get additional cash returns, I think that's the place you want to look at as well.
All right, we're going to do a bit of before we go, we got to do a bit of rapid fire questions to get your take on it. So I'm going to ask one question. You guys both just kind of chime in first. Well, I'll have Kendra first, but
Yeah.
where am I likely to get better returns, A or H shares?
On a technical basis, we like A, but on a 12-month basis, we think both markets will generate about 10% returns.
12 months basis A, but in the risk on trade, so for trading opportunity, better beta in H.
Okay, China tech or U.S. tech, Kendra?
Next 12 months, better return.
12 months. We like both.
Okay, Winnie?
Consensus would definitely say U.S. tech.
Yeah.
China tech, we would be, both very selective. U.S. tech is narrow to even less than Magnificent Seven, right? But China tech, we like a few selective names that can defend market share and defend margins. Very selective.